Imagine waking up tomorrow and realizing the cash in your savings account buys half of what it did 5 years ago. Now imagine holding an asset that has quietly done the exact opposite, climbing relentlessly while everything else shakes. We are witnessing something historic in the gold markets right now. It's not just a price spike, it's a signal. With gold hovering near record highs of over $4,380 an ounce, the financial tectonic plates are shifting beneath our feet. Why is this happening? And more importantly, is it too late to pay attention?
This isn't just about jewelry or wealth preservation for billionaires anymore. The surge in gold prices to these levels is a direct reflection of global anxiety. When gold moves this aggressively, up over 65% in just the last year alone, it's usually predicting something bigger than inflation. It's signaling a loss of faith in traditional currency. Whether you're an investor, a saver, or just someone trying to pay the bills, understanding why gold is exploding right now is crucial for protecting your future purchasing power. The dollar is strong, yet gold is stronger. That decoupling is a warning sign we cannot ignore.
To understand this moment, we have to look back. For nearly a century, gold was priced at just over $20 an ounce. Then came the end of the gold standard in the 1970s, and prices started to float. We saw peaks in 1980 and 2011, but what we are seeing today dwarfs those numbers. Historically, gold acts as the canary in the coal mine. When central banks start buying gold in record amounts, which they have been doing consistently for the last few years, they are hedging against their own systems. Just recently, spot gold prices broke through major resistance levels, sitting comfortably above $4,300. This isn't a sudden blip. It's the result of months of accumulation, geopolitical tension, and a market realizing that safe haven assets are in short supply. Let's look at the hard data. Currently, spot gold is trading around $4,387 per ounce. In the last 6 months alone, we've seen a jump of nearly 29%. If you zoom out to a 5-year view, the increase is over 130%. What does this tell us? It tells us that this rally has legs. It's sustained. We are seeing trading volumes spike, with over 30,000 contracts moving daily on major exchanges. This is institutional money moving, not just retail traders. So, who is buying? It's not just your neighbor buying coins. Central banks are hoarding. Major economies are diversifying away from the US dollar. On top of that, we have interest rate uncertainty. Typically, high interest rates hurt gold because gold doesn't pay dividends. But right now, gold is defying gravity. It's rising despite high rates. That is an incredibly bullish signal. It suggests that fear is a stronger motivator right now than yield. We can't talk about gold without glancing at its volatile cousin, silver. Silver is currently trading around $69 per ounce, up over 85% in 6 months. Often, silver acts like a slingshot, lagging behind gold and then snapping forward aggressively. The gold-to-silver ratio is currently tightening, suggesting the entire precious metals complex is in a massive bull run. What happens next? AI forecasts are predicting gold could breach the $4,500 mark soon. Some bullish analysts are even looking at $5,000 as a realistic target within the next year or two. If gold continues this trajectory, it forces a conversation about the stability of fiat currencies. We might see a return to asset-backed digital currencies or a complete overhaul of how we view safe investments. For the average person, this means the cost of tangible goods could continue to rise. If gold is the thermometer, the economy is running a fever. Ignoring this trend means gambling that the thermometer is broken, a risky bet when history shows it's usually right. The numbers are clear. $4,387 gold is not an anomaly, it's a statement. The financial landscape is changing, and wealth is moving from paper to hard assets. The question isn't whether gold will go up or down tomorrow. The question is, 5 years from now, will you wish you had paid attention to the warning signs flashing today? If you found value in this breakdown, make sure to like and subscribe so you don't miss our next deep dive into the markets. We'll be watching the charts so you don't have to. Stay ahead of the curve.